Welcome back to Drift Shield, where we break down the complex financial forces impacting driver wallets across the United States. If you have opened your auto insurance renewal statement recently, you probably noticed a steep price jump that left you feeling frustrated. You are certainly not alone, because millions of drivers are watching their monthly premiums climb to historic highs. This overall surge is not just random price gouging by big insurance corporations looking to make a quick profit. Instead, it is the direct result of massive underlying economic shifts that have reshaped the entire automotive sector. Over the course of this breakdown, we will examine why your coverage keeps getting more expensive every year. To understand what is happening to your insurance rate, you first need to understand broad economic inflation. When prices rise across the economy, the cost of everything involved in managing a motor vehicle accident goes up too. Insurance companies do not set their pricing in a vacuum. They calculate base premiums based on projected future losses. When general inflation hits high levels across physical goods and services, the money set aside for claims evaporates quickly. This forces insurance underwriters to adjust their pricing algorithms so they can stay solvent and cover claims. Consequently, drivers end up paying higher baseline premiums even if they have never been in an accident themselves. One of the largest hidden drivers behind rising car insurance rates is the skyrocketing cost of replacement parts. Modern vehicles rely heavily on original equipment manufacturer components rather than cheap generic alternatives. Automakers design newer cars with proprietary materials like ultra-high-strength steel, aluminum alloys, and carbon fiber blends. These specialized materials are extremely expensive to produce, ship, and replace when a vehicle gets damaged. Supply chain disruptions and rising raw material costs have pushed the price of basic body panels through the roof. When a simple fender bender requires thousands of dollars in replacement hardware, insurance companies must adjust premiums upward. Vehicle technology has advanced faster over the past decade than at any other time in automotive history. Today, almost every new automobile comes equipped with advanced driver assistance systems designed to keep you safe. Sensors, radar units, sonar modules, and digital cameras are embedded behind front bumpers, side mirrors, and windshields. While these high-technology systems help prevent crashes, they transform minor cosmetic bumps into massive financial claims. A basic plastic bumper replacement that once cost $300 can now easily run upwards of $3,000. Insurance carriers must pay these inflated claims, which directly forces baseline policy prices higher for everyone. Windshield damage offers a perfect example of how modern automotive technology drives up everyday repair costs. In older cars, replacing a cracked front windshield was a quick procedure that cost a few $100s. Today, windshields house delicate optical sensors and forward-facing cameras that control automatic emergency braking and lane keeping. Replacing the glass is only the first step because technicians must also perform precision computer recalibrations. These calibration procedures require specialized shop equipment, software licenses, and hours of careful labor by trained mechanics. Insurance policies absorbing these high windshield claims must raise premiums across their entire customer base to cover expenses. Beyond the physical cost of parts, the automotive repair sector is facing a severe shortage of skilled technicians. Older master mechanics are retiring from the workforce at a faster pace than new apprentices are joining. To attract and keep qualified repair staff, collision repair shops have had to raise hourly labor rates dramatically. High technician wages, combined with extended training requirements for electric and modern vehicles, increase total shop repair bills. Insurance carriers pay these labor bills directly on behalf of policyholders during collision claims. As shop hourly rates continue to climb, insurance underwriters have no choice but to raise rates accordingly. When auto repair shops experience technician shortages and parts delays, vehicles sit in repair bays much longer. A repair job that used to take 3 days can easily stretch into 3 weeks while waiting on parts. During this extended waiting period, the insurance company must pay for the policyholder's rental vehicle coverage. Paying for weeks of rental car fees on top of high repair bills inflates total claim costs significantly. Insurance companies track these expanding claim totals and adjust their regional risk calculations to preserve financial margins. Drivers ultimately bear the brunt of these prolonged repair delays through higher annual insurance bills. It might seem logical that safer cars equipped with computer sensors would lead to fewer insurance claims overall. However, while modern safety technology has reduced overall crash frequency, the severity of individual claims has increased. Drivers on highways are traveling at higher average speeds, leading to higher impact forces when crashes occur. High-speed collisions destroy expensive electronic components, deployment airbags, and complex structural frames beyond simple repair. When crash severity increases, the dollar amount required to resolve a single claim reaches astronomical levels. Insurance companies must collect higher base premiums from all policyholders to maintain adequate cash reserves for these heavy losses. When a damaged vehicle is deemed too expensive to repair, the insurance carrier writes it off as a total loss. In a total loss claim, the insurer must pay the policyholder the full actual cash value of the car. Because used car values spiked dramatically alongside overall inflation, paying out total losses became vastly more expensive. To cover these massive capital outlays, underwriters adjusted their core risk models across every demographic market. High vehicle replacement values remain a major underlying force keeping car insurance rates elevated for everyday drivers. Car insurance pricing is not just about fixing bent metal and replacing broken glass on damaged vehicles. A large portion of your monthly insurance premium goes toward personal injury protection and medical liability coverage. Healthcare costs in the United States have consistently outpaced general economic inflation for many consecutive years. Hospital stays, emergency room visits, physical therapy, and diagnostic scans cost considerably more today than in past years. As medical inflation continues to climb, insurance carriers are forced to adjust bodily injury rates upward. Extreme weather events across the country have created another massive headache for automotive insurance companies in recent years. Hailstorms, flash flooding, wildfires, and hurricanes destroy thousands of vehicles simultaneously in catastrophic single-day events. Comprehensive coverage claims for flood-damaged cars or hail-pitted body panels have surged to record numbers across many states. As severe weather becomes more frequent, comprehensive auto insurance premiums inevitably rise to compensate. Many drivers wonder why their auto insurance rates suddenly jumped even after national inflation began showing signs of cooling. Insurers must submit detailed pricing requests to state insurance commissioners and wait months for formal regulatory approval. This bureaucratic approval process creates a major time lag between when expenses rise and when premiums adjust. As insurance premiums become more expensive, a growing number of motorists choose to drop their coverage entirely. When an uninsured driver causes a highway collision, the insured victim's insurance company must step in and pay. To cover this growing operational risk, insurers raise uninsured motorist premiums for responsible, paying policyholders. Legal expenses and attorney fees represent another hidden factor pushing insurance premiums higher across the country. Every dollar spent on legal defense and inflated court settlements must eventually be recovered through higher customer premiums. Vehicle theft spiked significantly in recent years, driven by social media trends targeting specific car models. Furthermore, the widespread theft of catalytic converters containing valuable precious metals created a massive wave of insurance claims. Repairing an electric vehicle after a crash requires specialized technician certifications and expensive safety protocols. Insurers track a key financial metric known as the combined ratio, which compares claims payouts to collected premiums. While macroeconomic inflation is outside your control, you are not powerless against rising insurance costs. Consider raising your policy deductibles or shopping around with different insurance carriers every year. Analyzing your vehicle's actual market value helps you avoid over-insuring an asset that continues to depreciate. Thanks for watching the video on Drift Shield today. Drive safely out there, and we will see you in the next video.